Tensions overseas keep traders on edge. In today's cover story, inside the explosive accusations that the Fed and Goldman Sachs are too close for comfort. Plus, climate change becomes a hot investment, and investors are already finding new ways to play Alibaba. First Business starts now.
You're watching First Business. Financial news, analysis, and today's investment ideas.
Good morning, everybody. I'm Angela Miles. It's Tuesday, September 30th. In today's First Look, September lives up to its reputation as a volatile month as stocks slide on Monday. The Dow fell 42, the Nasdaq 6, the S&P also dropping by 6, gold rallied $1, and oil 96 cents. Ford fumbles on recalls. Shares plunged 7% on word from its investor day that a recall last week will cost the car company $500 million. And sky-high costs at Chicago's O'Hare and Midway. A report says the fire that stopped flights for hours on Friday will cost the airlines hundreds of millions of dollars. Time for some trader talk on this Tuesday morning. Brian Battle of Performance Trust joins us, and boy, there's uncertainty all over the globe. It's happening in Ukraine, Iraq, and now Hong Kong has those protests underway. How's that affecting the market?
I think it's bad news all the way around. You know, we know the Federal Reserve and all the central banks are trying to make their currencies cheaper. We know that. We know sanctions against Russia is going to hurt global GDP. Exactly what we don't need is for there to be instability in China, because they're supposed to be the ones that are one of the stalwarts for global GDP growth. So watching very closely in Hong Kong, seeing what happens there. I think that the Chinese are smart enough not to do a repeat of what they did at Tiananmen. However, this is something that we really don't need in the mix right now, and especially at quarter end. This is the end of the month here today, so it's going to be a very, I think, a whippy day today.
And then we have to mention the Chicago Fed putting the brakes on raising interest rates. What do you think about that?
Yeah, and so Dallas Fisher was saying, we got to worry about inflation. We got to raise rates sooner. And then Charlie Evans said, hey, no, we're going to take it easy. Everything's okay. We're not too worried about it. So more uncertainty. We've got two different guys saying opposite things at the Fed. Not helpful. What we do know is the Fed has never ended quantitative easing. They've started it a bunch of times. They've never actually ended it. And that's coming up in October. So another exciting thing, more for the bond market than for the stock market.
Busy day. Thank you, Brian.
You're welcome.
Diane Mocha is filling in for Chuck Coppola today and joins me now. Good morning.
Good morning, Angie. Financial markets are riled up as protests continue in Hong Kong. Thousands of demonstrators are bracing for a police crackdown as they defy the government. Protesters are outraged over a recent ruling by the Beijing government that they say could threaten democracy in upcoming elections. Hong Kong's leader calls those claims unfounded. Hong Kong is a semi-autonomous part of China. However, Beijing has strong political influence. In mainland China, reports say the government has blocked photo-sharing app Instagram.
The European Commission may release details today about alleged tax sheltering by Apple. Apple is accused of striking backroom deals with the Irish government. The investigation launched in June after a U.S. Senate committee claimed Apple was moving profits through Ireland while paying a special tax rate of 2% or less to avoid billions in taxes in the U.S. If it's true, Apple could owe a record multi-billion-dollar penalty. Apple is sticking by a statement in June saying, we have received no selective treatment from Irish officials. In the U.S., Apple fans are still lining up to buy the new iPhone 6. The stock traded last at $100.
Today's cover story looks at what's being called the Ray Rice video for the financial sector. Bloomberg View columnist Michael Lewis is referring to 46 hours of conversations between banking regulators and Goldman Sachs, secretly recorded by a Fed examiner who says she was fired for trying to blow the whistle on a conflict of interest. While bankers gripe about stricter regulations, recordings made by fired Fed examiner Carmen Segarra raise serious questions about whether the Fed has really changed enough to avert another financial disaster, according to This American Life. The public radio show recently delved into a Goldman Sachs deal discussed at length by Segarra's bosses, including Mike Silva, the head Fed official inside Goldman Sachs.
We're looking at a transaction that's legal but shady.
ProPublica reporter Jake Bernstein obtained the tapes exposing a questionable deal between Goldman Sachs and Banco Santander, which was being required to hold more capital. Goldman Sachs got around the rule by taking some assets off Santander's books to hold them for a couple years. Segarra's concerns didn't convince the Fed to block the deal.
This is really what people describe as regulatory capture, this idea that the regulators are too cozy with the banks that they're actually regulating.
Segarra, a Harvard-educated lawyer, was hired after a confidential 2009 report suggested the Fed bring in examiners who would speak out and contradict their bosses. She recorded the conversations using a hidden mic and a keychain while overseeing Goldman Sachs, and she says she was fired for being too aggressive.
I think you take a disgruntled employee with 46 hours of tape. That's the beginning to any beautiful conspiracy.
Trader Todd Colvin says it's no surprise banks find ways to circumnavigate certain Fed obstacles and doubts the tapes will have any impact.
Is this a damning video to the Fed? No, I don't think it is ultimately going to be any sort of a mark against them moving forward. And if it were, the markets would already be telling you that.
Goldman Sachs closed last at 183.83 and is up more than 14% from October 2013 when Segarra filed her wrongful termination lawsuit. That suit alleged that the Federal Reserve Bank of New York ousted Segarra for refusing to go soft on the investment banking behemoth. The Fed has denied any wrongdoing in the case, and so has Goldman Sachs, which is not a defendant in the suit.
Bank of America will pay $7.6 million to settle SEC charges of inaccurate accounting. The SEC claims for years B of A incorrectly accounted for a type of debt it inherited when it acquired Merrill Lynch back in 2009. Bank of America made the disclosure after discovering the mistake.
It's trial time for AIG. Shareholders are in court this week alleging the government violated their constitutional rights by bailing out AIG in 2008. Government lawyers call it appropriate, saying bankruptcy was the only other alternative. AIG repaid the bailout, leaving taxpayers with a profit of $23 billion. Expected on the stand, former Fed Chairman Ben Bernanke, Tim Geithner, former president of the Federal Reserve Bank of New York at the time, and Maurice Hank Greenberg, AIG CEO until 2005 and its biggest shareholder.
The Lloyds Banking Group fires and fines 8 employees for what it calls totally unacceptable behavior. The behavior in question is a manipulation of global benchmark rates during the financial crisis uncovered by regulators. In July, Lloyds paid $380 million to British and United States authorities to resolve the governmental investigations into the rigging of the LIBOR rate. In addition to the firings, the bank recouped close to $5 million in bonuses it had paid those employees.
Aftershock in the financial industry follows the departure of PIMCO investor Bill Gross. The Wall Street Journal reports PIMCO customers withdrew $10 billion on Friday after Gross revealed his plans to leave. Analysts say the total losses could mount to $100 billion or more. Monday, PIMCO CEO tried to calm fears on a conference call, saying, "I'm confident the vast majority of our clients will stay with us."
Troubled retailer American Apparel has more drama unfolding as it replaces its interim CEO. Turnaround specialist Scott Brubaker replaces John Literal, who's been on the job only since June. American Apparel's founder and former CEO Dov Charney remains under investigation for a litany of allegations against him. Shares of American Apparel closed 2% higher yesterday at 80 cents.
One of Canada's largest natural gas producers gains traction in the U.S. market. Calgary-based Encana Corp will buy Athlon Energy of Texas for nearly $6 billion in cash. Encana will pay $58.50 a share, a 25% premium on Athlon's share price. The move gives Encana a foothold in the most prolific oil-producing region in the United States.
A real deal may be happening for DreamWorks. According to a report, Japanese conglomerate SoftBank is in talks to buy DreamWorks Animation. DreamWorks has churned out several hits, including Shrek and How to Train Your Dragon. The deal reportedly could be worth $3.4 billion. DreamWorks shares surged 26% on Monday. Movie maker Lionsgate traded more than 5% higher as investors speculated that it, too, may be up for grabs.
Macy's is spreading holiday cheer with big hiring plans. The department store will add 86,000 seasonal workers this Christmas. That's 3.6% higher than last year. The retailer is staffing up as it tests new ways to please customers, including same-day delivery for online shoppers in 8 markets. Paula Rosenblum of Retail Systems Research says retail workers play a key role in the shopping experience.
The object of the game is to make the in-store experience more pleasant again. And the only way you're going to do that, all the data we have tells us that right now the only way you're going to do that is with employees. You've got to have people to engage with the customers.
Walmart, Kohl's, and UPS are among others pledging to add thousands in what is expected to be a robust holiday shopping season.
More investors are taking a closer look at GoPro as the company rolls out 3 new cameras. GoPro shares shot up 10% on Monday. On the high end, the company released the Hero 4 Black at $399. It's capable of shooting 30 frames per second. At a slightly lower end, the Hero 4 Silver will sell for $399, and a new entry-level Hero is on sale for $130. GoPro is going after everyone from professional filmmakers to soccer moms. The cameras are the size of a box of Tic Tacs.
The future of Microsoft is here. The company is expected to unveil its new version of Windows today. It's reportedly codenamed Threshold and is the first of several updates to Microsoft's operating system. Microsoft had a wave of bad press over its last operating system, Windows 8. Shares are trading above $46 ahead of today's big event.
Famed New York Yankee shortstop Derek Jeter has played his final game. Since announcing his retirement in February, it has been a bull market for Jeter memorabilia. A World Series game bat from his rookie year is going for more than $155,000. On the other end of the spectrum, a single sock worn in a game will set you back $400. Experts caution it may not be much of an investment since Derek Jeter will likely be signing autographs for many years to come. On the economic calendar for today, it's a Case-Shiller 20-city index, Chicago PMI, and consumer confidence. On the earnings calendar, Walgreens. Still to come, Alibaba gives investors exciting new options, plus a feud between funds and a crash course in ways to invest in climate change. We'll be right back. Staggering amount of money is expected to be spent during the next 10 years cleaning up the environment. So savvy investors are also hoping to clean up with profits by investing in companies devoted to the environment. Joining us on set this morning, Nina Mishra of Zacks Investment Research. She's here to highlight a few ETFs. Welcome and good to have you here on the show.
Thanks for having me.
Let's start with the EVX. Tell me what this is all about.
It's Environment Services ETF. So it's basically holds companies which are involved in cleaning up of environment. My problem with this ETF is that it has very low amount of assets and it trades in meager volumes, which raises the trading costs for an investor. And when assets under management are very low, it always raises the risk of closure for an ETF.
So very risky, but on the other hand, it could explode to the upside. There's always that potential.
That's also possible.
All right, another name on your list is PBW.
It's a broad alternative energy ETF. So companies which invest in solar, wind, nuclear, water power, those kind of companies, and also companies that facilitate these kind of technologies. And this holds US companies. And if you want a global approach rather than a US-centric approach, then you can consider something called PBD, which is the global clean energy ETF. Solar energy is becoming very popular these days, you know. TAN is the ticker, is a good option. It holds US as well as global companies which invest in solar power.
Well, great to have you here. Come back soon.
Thank you.
Nina. Coming up, why some pension funds are consciously uncoupling from hedge funds and ranking the rich. Who made the cut of the list of the world's wealthiest people after the break? Well, there's the 1%, and then there's the Forbes Rich List. Topping the list for the 21st year in a row, Bill Gates. His net worth is $81 billion. Joining him is Warren Buffett with a net worth of $67 billion, followed by Larry Ellison, the former CEO of Oracle, with a net worth of $50 billion. The politically active Koch brothers occupy the 4th and 5th spots with net worths of $42 billion each. A couple of hedge fund managers also made that list. Bill Mueller has more on why poorly performing funds are being dropped by investment groups.
Income inequality. You see it in a new Harvard study that finds that CEOs make more than 350 times the average worker's pay. You see it in the astronomical sums that hedge funds make, including their managers. CalPERS of California, that's the largest public employee pension fund in the country, it's decided to pull billions out of its hedge fund investments. Is this a big change about to happen? There's an article in the October Harvard Business Review saying that this income imbalance cannot long stand. It was written by Roger Martin, former dean of the Rotman School of Management at the University of Toronto. Let's talk about these pension funds and hedge funds. You say this is an act basically of sleeping with the enemy. How so?
Hedge funds are most interested in short-termism and volatility, and pension funds for their pensioners should be interested in long-term appreciation, so lower volatility, and companies being able to act in the long term. So by funding hedge funds, they're operating, I think, against the interest of their pensioners.
Now, hedge funds depend on pension funds because those are the largest single sources of huge inflows of money. Do you think this is going to be a trend? Is CalPERS in the vanguard of something happening here?
I really, really hope so. I mean, I think it would be much better for the capital markets, much better for the economic performance in general if hedge funds were a much smaller part of the investment world than they are now. And the only way for that to happen, I believe, is for pension funds to cut their funding of the hedge fund industry.
And might there be also regulation in this area too?
I mean, I think so. As I say in the article, I think the fee structure of hedge funds is not consistent with the interests of pensioners, right? And so pension funds are already regulated. They have fiduciary obligations. They can only have so much of their investments in non-investment graded securities. Those are all to protect the pensioners. The pensioners have no interest or alignment with the notion of hedge funds being given 2% of assets under management plus 20% of the upside. The 2% pays for them to get rich. The 20% then gives them an encouragement to swing for the fences. That's why over a 5-year period, a third of all hedge funds disappear, right? Because many of them swing for the fences. That's simply not in the interests of pensioners.
All right, Roger Martin, thank you so much.
My pleasure.
Just ahead, exciting times in the options market as Alibaba options trade for the first time. Find out what happened next in Chart Talk. Alibaba options traded for the first time ever on Monday. Joining me now, Matt Shapiro. He's president of MWS Capital. He's a big-time money manager now, but back in the day, he was an options trader on the options floor. Good to have you here, Matt.
Thanks, Angie.
What are your thoughts on those BABA options?
Well, I'm laughing a little bit, like as if investors need something new to bet on, with the market as it is. But, actually, the options that started trading yesterday showed a lot about the technical position of Alibaba. So contrary to people's expectations, the options actually were very cheap. Lower than people thought they would be, meaning Alibaba is not going to move as much as people might ordinarily expect.
That is so true. In fact, a lot less expensive than what we saw perhaps with Facebook when it IPO'd, and the implied volatility spiked right out of the gate.
Right. Back then, what was this, 2 years ago, Facebook had a really botched IPO. The options were much more expensive and the stock did move down. But the market doesn't expect that with Alibaba because so many big-time fund managers really need to buy it. So there's an endless supply, there's an endless bid, rather, for the stock below. So even if it does trade down below 80, people perceive it to be relatively slow. So the perception is Alibaba will not move more than about $10 or so over the next couple months.
Right, so that means there's just not a lot of risk that the options market is pricing in. But say we get an earnings or a big event that happens coming up in Alibaba, do you suspect then the implied volatility or the risk to the stock will become higher?
Well, naturally, any earnings month options have a higher volatility, and for Alibaba, it's actually the December. People don't perceive that Alibaba is going to trade or move a lot over the next couple months, but late in the year, when they open its books for its first earnings report, potentially it could jump if they come out with a blockbuster earnings.
Right, and it looks like in the options market, people are still thinking that Alibaba could get to $100 or higher in the near term. So we'll have to see what happens there, Matt.
Yeah, it really can. I mean, think about a few days ago, the stock was down 87, and then it jumped up really quickly to 92. So anytime there's a little confidence back in the market, back in Alibaba, the stock can easily go up $5 in any day.
Well, thank you for coming on today, Matt. Have a good day.
You too. Thank you.
Well, that's enough Bobble Babble for now. Coming up tomorrow, a trader turned comedian. He says his best material comes from working on Wall Street. We do not doubt it. From all of us at First Business, have a terrific Tuesday.